Good morning and welcome to the Macro Show for Tuesday, August 8th. I'm Teo Burnett, an analyst here on the Macro and Financials team here at Hedgeye, and I'm joined in studio with Hedgeye CEO Keith McCullough. As a reminder, if you have any questions, please put them below the video player, and we'll do our best to get to them at the very end. And with that, I'll turn it over to you, Keith.
Thank you, Tex. Yeah. His nickname is Tex because he's from Tejas, just FYI on that. And welcome to all of you, to my lovers and haters. May you never meet, but today you get to join for free on the Macro Show, the latter being, and I do love you, just a big kiss from Hedgeye Nation. All right, now let's get into it this morning. China, interest rates, and volatility. We got a lot going on here. Remember the time, Tex, when our competitors were saying the June PMI data and the industrial recession has already happened? It's priced in.
I do. And well, we were calling it.
Well, unfortunately, today is August, and that is July data, not June. And it just, I think that it would be unfair to call the Chinese data recessionary. It is downright depressionary, okay? So this morning, whether you look at the export number going to down negative 15 almost, if you round down, versus down 12.4% last month in June, or see an absolute collapse in Chinese demand on imports, now down towards 12.5% after being bad at down 7%. So if you thought down 7 was bad, down 12.4 is a lot worse. And this is the point. China is slowing at a faster rate in the third quarter. We call that quad 4, when you have both the rate of change of both growth and inflation slowing at the same time. This is why the Chinese are panicking and providing cowbell, or at least alluding to it, but not really doing anything. So again, this is a major problem. As soon as this hit, this data hit, of course, it hit the bond market, it hit copper. Copper's now down a full 3% this morning after failing at trend resistance, which is a textbook move in the Hedgeye model. We have trades, trends, and tails. Yeah, you got slide 9 there this morning. Celsi, look at that. He's on his game. Slide 9. These are, again, looking at, that's the quad model. Next, slide 9. Slide 9 is the one where it shows the trade, trend, tail model. So there you go. So trades, immediate-term trades, intermediate-term trends, and long-term tails. And yes, you are multi-factor and multi-duration in your process. Moving monkeys, no, you're not. Okay? So pay attention to it all, because it matters. Bond market, saw this, obviously, so point number 2 this morning is interest rates. So if you look at what's going on in Europe, it's not just China. It's not just that. These Italians decided to go and put levies, taxes, on the banks that were, they got to give some back. That's the way that socialists kind of think about it. Give the people back some more. I think they called it some support for the mortgage holders with rising interest rates. You see where European rates are? I mean, come on. But this is what's happening. You also have the downgrade, of course, of the U.S. banks by Moody's, which is a little late, but still matters. As we talked about on the call, it absolutely matters, even though they're late. We downgraded the banks like 20 months ago. But that notwithstanding, you got a big problem here in European banks, and that's why our European equity shorts, top 3 shorts being Germany, France, and Finland. And again, my mistake was not having added Italy back, but on a bounce, I will. Italy is laden with European bank exposure, as you can see, and that's a major problem. Interest rates generally now have a different setup. So you can see, and I'll get into volatility here in a second, what happens is that if you're a U.S. macro tourist, you know who you are. It's a free show. Welcome. You're just a tourist, right? You jump from headline to headline. You're all looking for the CPI next week, or on Thursday. Last week was about the jobs report. You just jump from headline to headline. You don't have a process. You don't have a rate of change. You don't have a rate of change measuring a mapping process to get you to what the likelihood of the next number is. No, you don't. You just jump around. Yeah. I want to play against that all day long and have for going on 24 years. Okay, so again, a tourist is now looking at a very difficult position, even though they don't know it's difficult. Because what you have is, based on this smackdown from both a European bank perspective and China, you get bond yields on the short end of the curve, which is Fed policy expectations, right at the low end of the range, right before the CPI jumps up. It's going to accelerate from last month. So again, you saw that acceleration in oil, for example, of 20%, and the base effects easing by 29 basis points. Did you know that? Now you do. That's why you're watching. This is why people pay for it, right? So again, that's what's going on. Now the volatility setup is surreal because we're finally entering what we would call a phase transition. So it's the particular, as my friend Benoit taught me a long time ago. Again, God rest in peace, Benoit Mandelbrot. Again, it's the particular in markets that matters, not the average of things or the simple moving average. That's what a moving monkey is. It's a simple one-factor moving average. Talk about the innovation. on Wall Street.
That the whole world can see?
Yeah, it's holding the 200-day Apple. It's like, come on, guys, just retire. I mean, Apple's just getting killed. But back to the volatility of it all. So the setup is really interesting because instead of like a flat term structure for short-term volatility, I'm talking very short-term, which includes the catalysts on the events calendar, which includes what just happened this morning and getting through Thursday's CPI. Now you have a little contango there. So again, that means there's an actual chance for volatility to break out at a faster pace, and that's what my model's saying. So vol, we got a big higher low on the VIX. The volatility of volatility is widening and rising at the same time. That's a dangerous setup, in particular when you have dealer gamma. So dealers now have negative gamma. It's not positive gamma, like buy the damn dip gamma. It's sell weakness. That's what the setup is from the options dealers. That's a major problem. And moreover, you have what we wrote here in the early look, our content partners, and thank you very much for that to Craig Peterson, vol control funds. You know what that is? Oh yeah, Kramer talks about all that. No, old wall people don't talk about the flow. They don't understand the flow. They probably don't even understand what a gamma squeeze is or the difference between negative and positive gamma at the dealer level. But because they don't understand doesn't mean that that's not what's going on. It's like playing with hockey with a wooden stick. They still like their wooden sticks, but I prefer graphite. Yeah, I prefer some technology. So there you have it. When you're below that flip line, by the way, which is currently the flip line on dealer gamma, that line's 44. So you can see that every single day. If you have the data that you pay for, of course, you'd pay for good data instead of bad narratives. But this is a very big problem because volatility control funds could be a seller of upwards of $35 billion in equity right on the tape on a 2% drop in the S&P 500. Whew. CTAs are big time long, hedge funds big time net long. We're coming off the biggest ramp in leverage. If you look at the FINRA data, FINRA like talking about buying stocks with leverage, buying on borrow, ever on a 6-month basis. A bunch of hedge funds are already blowing up because of yesterday was the only first up day in 5, and you're going to get a down open here. So again, be aware of the reflexivity, as we would call it, on the downside, and those are your top 3 things. All right. If you want to learn something, read. Then take what you read and implement it, if you can, into your process and evolve. Okay. For those of you that do not know what a fractal dimension is, but you know what a moving monkey is, I challenge you, and I'm challenging everybody really who's watching this for free. I want you to hate that. I want you to hate having to change. I want you to learn. Some of our best subscribers and clients hated me with a passion. That's possible. You know it is. But again, I learned a lot from this guy. You read the book. First of all, read it like 5 times and try to understand it. And then understand that there's a beauty to fractal patterns. It defines, the contour of an ocean line or the edges of a leaf. You know what those things are, right? Well, how about economies and market systems? Okay, so this is our process. It's embedded in all that we do today. Look at all. You got a lot of dog ears in that book. That's not your dog eating my book. That's a lot of dog ears. But one of my favorite passages in this book is in pages 170. And by the way, if you really pay attention to the book, you're going to be able to try to calculate some of the fractals implements that I use to calculate things like trade trend tail lines. Again, my risk ranges. I'm not going to give up the codes, but I give you the process. So again, when you think about this, I want you to keep thinking. Okay, so when we get into this in initiators, generators, and rules, that's how a fractal, if you were to just at a very basic level construct a fractal pattern, that's what you need. An initiator, a generator, and rules. So think about it. Initiator, vol picks up. We get some contango on the curve. Whoop. Generator, Chinese data, very, very bad. Markets go down a little faster. Copper go down real fast. Copper's not a stock. Wait for the people that do stocks to wake up. Initiator, generator, rules, sell. That's it. A lot better than the moving monkey, right? And actually, if you look at a fractal, you'll see a pattern of beauty. Every fractal is a logical expression of a few straightforward ideas. I would submit rate of change in gravity. 2 very straightforward ideas that affect all of your life. For whatever reason, some of you are still infected by the old wall and their broken ways. This is a better way. Thank you for joining us today. All right, get into the groove here. Still working on my paunch. Emily said that I have a bit of a paunch. So I got to lose that. Emily Evans on the call. Thank you. She didn't really say it. I kind of like saying it that way. 44. So big problem here day over day is that we see some degradation, and I wrote this intraday, for those of you that stopped subscribing to real-time alerts or those of you that are new to it, we appreciate new subscribers. Old ones never had my coaching alerts. It's very different now. So what I called out yesterday, I said, hey, watch out for this, in particular, two things. This 42 used to be 75, and this number here used to be closer to 80 or something like that. So what you have is the third day in a row of lower highs and lower lows in the risk range. That is definitively bearish. Okay? This is what widens the risk range. We have more vol in the model all of a sudden. That's why for the second day in a row, we have a 14 handle at the, so when you look at the risk range on the VIX, and these things are published every single day, so power users of the process already know what I'm going to say because it's already on their pin sheet, as we like to say. But again, the vol 14.18, this is a higher low for that, and obviously we have a new a higher high at 17. This is on a very immediate term duration. Okay? So this feeds that, okay? Our model is price, volume, volatility, PVV. Am I blowing the mind? Can you imagine if people just looked at numbers instead of bullshit? You know, like political bullshit, people talking about their feelings on TV, how a stock feels, how they had an experience at the company. Again, it's bullshit, right? Evolve. This is a much better way to look at risk. Okay, it's the flows and the fundamentals, not just the fundamentals. As he taught me this a long time ago. A large percentage of market moves have to do with nothingness other than the flows. You know, Brownian motion. Look that up. That's a good one, Brownian motion. Now look at yesterday. It was the first update. So once we look into, so let's isolate the price volume. So this is the V. If you have the first up day in 5, and on prior down days, the volume accelerated. So what I'm looking for are similar sets or patterns, as you call them in fractal math. Here we have an up day in price, but a down day on volume. So down 8% and 5% respectively versus the prior day and the 1 month average. That's all that really matters. We highlight it every day. So again, a non-confirming day. So we sold into it. So I went from 13% net long 2 trading days ago, which you can see. Obviously, if you go back and rewind the tapes, if you're a subscriber, to I'm net short now by barely, but barely net short. So I just sold into it. And you can see me doing that in real-time alerts. If you didn't see it, that doesn't mean it didn't happen. You can sit there and say, oh, I get why you say that people are full of shit on Wall Street. They are, right? They don't have timestamps. I have like 8,000 of these damn things. You know how many screw-ups I have in there? Lots, right? But when I say I do something, it's because I actually did it. You know, so that's an important thing, right? An important concept. Play the game out loud. Be accountable to it and all your mistakes. But again, show people the process. So again, we got price, volume, volatility are all saying the same thing with a disconfirming signal on the relationship between the price and the volume component. It was a day where everyone was feeling good. 10 out of 11 sectors were up on the day. And the biggest moves were in the things that people want to buy if there's not going to be a recession. So I shorted both financials and industrials. We're short of the FUR, and I'm going pretty close to my max now. FUR being financials, industrials, real estate, and retailers. Okay? Not Qs, not yet. We did add SPY back to the short side after having it off for a long time, because we're not idiots, right? We're not like these people, SPY monkeys, that's all they know. Why is it that that's all they know? They don't have a team. They don't have a process. They have nowhere else to go, right? So that's all they talk about. Now, if they had 50 countries, all asset classes, a full-blown team that's growing towards 100 people here with 40 of us on the research team, they'd have some options. They'd do better. It's a better way. So here we are. Those are my top 4 sector shorts in terms of size this morning. Retailers are the 4th because they were down yesterday. IWM, which is a Russell, which I'm short, and I've been shorted. It's down 20%, don't forget, from where we went bearish. 20, right? So in other words, you got to be up 25% to get back to break even. Do you think some small cap manager whose clients are still down 20 are happy? No, just happy talk, bullshit on CNBC, right? These people got killed last year, absolutely killed. Now they talk about year to date. If you're down 20, which would be a good thing last year relative to what some people did, you got to be up 25 just to get back to break even. The goal here is number 1, to preserve and protect capital. So find the places where you're not going to have, never mind 20, 5 to 10% drawdowns. You know, that would be a disaster for me. What's typical is more down 2 to 3. You know, buy the damn dips and the things that we like. We have 26 different macro ETFs from Japan to India and back again, and they work. Okay, they've been working more than they haven't. So again, there's a better way to do it. There's a different way to do it. Even if it wasn't a better way, it's a different way, which is a better way anyway. Huh? You got that? Yeah. You know, if the SPY or the Qs don't go up, they all lose together. That's the point. Okay, and we don't lose when the crowd loses. That's for damn sure. And we didn't. If you're looking at calendar years, that's so old wall. It's cycle to date. The cycle peaked in November of 2021. So the Russell 2000 peaked at 2,442 November of 2021. NASDAQ peaked at 16,057. Yeah. So NASDAQ, even before we opened today, is still down 13% from there. 13. Right? Okay, so there you go. What else we got going on for you this morning? Just a little reframing for some of you that struggle with that. But for all of us in Hedgeye Nation community, maybe they're laughing at some of my bad jokes. The MOVE Index, you know what that is? It's at 121. What a great thing. No. We're not long anything that has to do with duration. I guess the closest thing to it would be gold, which isn't down so much this morning. And by the way, I cut my gold position in half into this, which everyone who subscribes to Macro Pro, where you can see my daily and incremental moves. You can see all my asset allocations, how I touch positions. Yesterday, I sold another 100 basis points of gold and a physical gold. That's 200 basis points. And now I get to buy them back. That's how you do it. That's how I do it. I'll do it for my family. How you do it is totally up to you. And that's something that people really need to get comfortable with. Who are you? What is your max size by position? How many positions do you want to have? Are your longs bigger than your shorts? How do you touch your positions, not with touchy-feely stuff, incrementally, mathematically, with discipline and rules? Again, initiator, generator, rules. Market go down, initiator, generates buy signal, rules, buy 50 basis points of that thing. Holy hell. We're applying fractal math, AI. I like AI. Been using it for years.
We have.
I think Rooster, which is why you're here today.
Well, we did. We already had this schedule set, but once he knew he wasn't going to have to be on, he said, "Oh, I can be up till 4 in the morning."
He emailed me at 1:47 a.m. today. Rooster's an analyst on our team. For those of you that subscribe, you know him. The other day, he's telling me how he had to go to the Mountain of Dew. So I'm like, what are you doing? Like I got up I couldn't sleep this morning, so I was up at 3:30. For those of you who saw my tweets, I started early. And I see this email from Rooster. I'm like, what are you doing? Like, I'm not happy about that. I want this guy to live, right? I want to have a life. Yeah. And he's like, no, we're going to get our final AI commercialized product out. I got to climb that mountain, is what he said. So I said, you get on the Mountain Dew again last night? He goes, no, I went to McDonald's and got a big Dr. Pepper.
I love the guy. I do. I really do.
But I asked you, lovers okay, but haters alike. Who's working for you like that? Like, who really is working? Are all these one-man bands? I mean, draw down Josh Brown. Are you kidding me? I don't even want to know what he's doing at 2 in the morning. So the fact of the matter is that that's what we're doing. That's who we are. If you like it, you like it. If you don't, you don't. Most people that don't can't compete with it. That's why they hate it, right? It's tough to compete with the Rooster at 1:47 a.m. on Dr. Pepper. Whoop! That's a real thing. Weaponized with his own AI models that we've been working. Those are coming to a theater near you. What else we got going on for you this morning? Just to hit on overseas markets. So again, I'll go through the U.S. markets. I do the top 3 things, go through the levels, et cetera, et cetera. Then we'll do the other places of the world where you can put your money, other places. So Japan, which is a place, our largest global equity allocation, was up last night. So I'm not going to lose my mind over that. If it was down, I wouldn't either. I'd buy the damn dip. So Japan was up 0.4%. We're along that. India, which is our second largest, was down 0.1%. Call your mommy. It's okay. Yesterday we sold some India and some Japan. Right? You can see that in the Macro Pro. They went down. So if they go down with the U.S. equity ETFs today, we'll buy some more. If they're near the low end of the range. That's what we're really picky about these things. We're patient. We have a process. Timing matters. All these things. People that on the old wall say timing doesn't matter. You can't time markets. Believe them, they can't. It's very good. Imagine you had to have Farmer Jim time the market for. I mean, good Lord in heaven, I pray. Hong Kong, which we're short on the other side, so we're not naked long like a yo-yo. I get that some people have to be, but it's called Hedgeye. If you could look inside of a hedge fund, what would you see other than annoying me? You would find that people have longs and they have shorts. The shorts are set there to protect the longs, protect the capital, the hard-earned capital, so that the capital can compound over time. So again, my shorts are down a lot more. Hong Kong down 1.8% on the China news. Great. Japan's up, Hong Kong down equals alpha. Initiator, generator, rule equals alpha. Good. That's a good session. Our European shorts, as I hit on, acting quite nicely. Something I'll be buying more of is Indonesia, IDX, which we discussed yesterday. Oil finally having a down day, so we're going to buy the damn dip in that. Yeah. Okay, so we got big higher lows. Our breakout signal on oil is about 5 weeks old, about with the Canadian accent, and that's right. We have a lot of Canadian friends that are long oil because they're always long oil. but the fact of the matter is that we have higher highs today back in the risk range as opposed to volatility. It's the upside down of this. So the volatility in oil keeps making lower lows. It's called OVX, oil volatility, okay, OVX. So that was closed around 27. So that's a new low for oil volatility. So we have higher highs in the risk range for WTI to 83.44. The best spot to buy more would be at the low end of the range, which is 78.55. So wait, where do you buy 25 basis points? If you don't know what a basis point is, we got a lot of work to do. But we're going to do it. Now, we like to coach players at all levels, level you up. But buy a little bit. But if it gets to the low end of the range, I buy a lot. Okay, so that's how we think of it. And I start buying short-dated call options. Blow my mind. Okay, we got videos on that too, how to do that. All right, what else we got going on? People say, why, if you're so good at this, why don't you go run a hedge fund? I have so much more fun doing this. You know,
you do have fun.
It's like as an agitator on the ice too.
Yeah,
it's fine. It's fine. I'd like to get some of you haters on the ice. Actually, it'd be fun.
I would fall my ass.
Oh boy, what do we got else? Gold, 1922. So gold today, we might get aggressive because it's right around there. In fact, I'm going to have to end the macro show in 9 minutes so I can do that. What else we got going on for you? I already talked about copper, corn's down hard, wheat down too, et cetera, et cetera. We have, again, that weak flow-through trade from the Chinese data to capitalize on certain things that we're long in commodity space. We're still bullish on inflation reaccelerating, which includes all of energy, being long the commodities and the stocks, and being long something like uranium, URA, or nuclear, NLR. Lots of things to buy. What else we got? 10-year yield risk range didn't really move. That's important. That's the setup that I'm talking about in the bond market ahead of the CPI. Bitcoin might signal buy.
It's been interesting.
We're going to see what happens here. So that's largely a volatility, it's price volume volatility signal, but the volatility component is starting to change here. But I said might. When I do, because I've been bearish on Bitcoin since it was at 68,000 or whatever, just when the cycle peaked back in November of 2021. So I don't really care what people think about Bitcoin. I care about what I do. Me, selfish bastard. Hodl, no. Risk manage, yes. Yes. Risk manage, yes. If you don't risk manage, you stay poor, I think they say. I think those hodlers like that stuff. But, low end of the range for a trade, I would, 28,708. That's for Bitcoin, and I'm waiting and watching on that. And if it says the next day that it doesn't, that's why you watch tomorrow. Let's take some questions.
So we got a couple, two of the top three are all around silver. So Alejandro's asking, is silver still a good buy in USD? And
the top questions for those of you that don't know when we allowed are always about what's your biggest loser today? Do you buy something when it's at the low end of the range? The answer is yes. That's it. No panic attacks. You know that I took silver down to a 1% position, which was down a lot from where I sold a bunch higher. It's not like gotcha. It's not bullshit, right? That's what I did. So now at the low end of the range, which is published, I will buy at least 50 basis points of silver if I see the low end of the range. Simple answer. There should be no anxiety. Our community, this is not the noobs, this is our community. Look at the anxiety meter this morning, right where I want it, right there. Not feeling too fat and happy when gold and silver paid out on the options when I sold them in real-time alerts. You saw it that day, actually much higher in silver's case. Sold my calls, I wrote about it, etc. Now you get to buy back. That's why they don't have anxiety, because they're not pinned, greedy bastards on one side. They're not losing their shit on the other side. They're right there. No emotion, executing like assassins.
I like it. Next one we got is from Rick Marchetta. He says, "Hi, Coach. Regarding IVOL discounts and premiums, I can't remember ever seeing so many consistent IVOL premiums and such a dearth of IVOL discounts. Is this a new paradigm? And if so, is the rate of change of IVOL premium to less premium as much a leading indicator as were IVOL discounts in the past?"
That's a lot.
Yeah,
it's a lot. It's a lot. Let's just reduce that. Let's just say, okay, if you know. And if you have the Tier 1 Alpha data, you can see this, where realized vol just went. And you look at the 1 month and the 3 month, the spread is very narrow. So let's just get into this here quickly. Show the implied vol table, which, apologies, I hit on every day. It's in your stat pack. You should be able to read this. There's plenty of information at Hedgeye University on how to think about realized vol versus implied vol, IVOL, as we have it notated here. So you have, this is implied vol versus realized vol. The reason why these numbers are very high is because realized vol is very low. And then, like I said, the term structure just kind of moved into contango. So again, implied vol, people are like, oh shit, I got to buy some protection. So you get, that's what happens. When people buy puts, premiums go up. So it's nothing new, actually. It happens 100% of the time that I get short SPY, which I did on the first day of August. This setup was there, and now it's manifesting. So now people are in a panic to buy protection because for a while they didn't have to. So the way that these, in particular, these volatility control funds, so they're rules based. It's not like they say, well, I thought the Apple quarter was great. It wasn't. It was dog shit. There's no conversation. It's all rules. So, they look at R vol, and if the R vol jumps, so R vol being realized vol, what's happened here is that the 1 and the 3 month vol is the spread on that is pretty tight. When that starts to widen out and you put in higher vol numbers into the model, they have to sell. Okay, that's basic explanation of it, but that's what's going on. So what I look for is complacency. So watch. Because I've already made money on these, and I'll make money again today. So people are paying premium for puts that I own. Okay. Whereas down in here, you're going to find the best thing to short today would probably be high yield, minus 12% implied vol discount. How about some Tesla, minus 9? That thing acts like shit, right? I mean, Tesla. Yesterday they finally gave up. Everyone owns Amazon, so nobody wants protection, right? Why would you want protection? You had to buy protection ahead of the quarter 1 week ago. That's a 55% premium. Then the thing go up, oh, no more puts, we're good. What's interesting about the magma or the magmant is that you have significant breakdowns. So you have Apple broke trend, like a hot knife through butter. That thing is, I think, 178 it went out yesterday. Tesla remains bearish trend. Microsoft's now bearish trend. So yeah, on the other side of it, Meta, Google, Amazon, those are the top 3 in our risk range product in terms of their bullish trend. Okay, buy the damn dip in bullish trends, sell the rips in bearish trends. But that is a very different setup than where we were in the month of, in particular, June. Like when you go back to the month of June, Taylor, you go to slide 28 in the current macro deck. By the way, if you pay for the real good stuff, there's 162 slides in this sucker. It's almost as heavy as like a small piece of gold, but it's heavy, heavy content. All right, now look at that. Look at that chart. Are you out of your fucking mind? Yes, you were. AI, they're not. Yeah. That's not like a kind of a move on that right side where call buying didn't just kind of like go at all-time highs. It blew through all-time highs. This was mid-June before any of these companies had to report anything. Okay? So this is where we're at. We're coming out of that. And this is a surreal environment for the mother of all bubbles. It wouldn't be the mother of all bubbles if those 2 charts weren't on the board. Okay? Next chart. Microsoft became almost 15% of the S&P 500. And now they're both bearish trend. I got a 200-day moving monkey. Like this guy from Funstrat, their old wall technical guy that they had to dig out of the frickin' back 40. This guy's like, oh, it's still holding the 200-day. I mean, where were you guys at 196 on Apple? Nobody was doing anything. I think the guy at Morgan Stanley capitulated and went like, no more bearishness.
Yeah, they lifted that.
I mean, we're having a moment here, people.
It's nuts.
Well, that got a lot out of me, that question. What else?
Okay, let's go to the next one. At a high level, Ivory Johnson kind of wants to know, hey, if CPI comes in hot and increases the odds of the Fed tightening, how do you think the yen and Japanese stocks look relative to the U.S. market, and how was the correlation kind of hold?
There's no real correlation to that in terms of like what we're looking for is number 1, where's the risk range on the yen versus the dollar, published daily. Number 2, where is the risk range on the Nikkei? Number 3, where is the risk range on the 4 Japanese ETFs that I have? And most important, so those are signals, and then there's quads. Signals, front run quads. Provided that we hold intermediate term trend support signal, volatility adjusted signal levels, and the economic data continues to be reported as quad 1 or 2 in Japan, you just buy it. It has nothing to do with the US CPI. That's the point, actually, really important question. There is a mania in CPI watching, right? You know that. Like, this is the first time in my career that everybody has an opinion on CPI. They don't have a model, but they have an opinion. The fourth turning's here, right? or you have an opinion on things that suits what you need to have happen in life or want, politically or otherwise. Whereas, there's this other thing called data dependence, apoliticalness. So again, this is a very good opportunity for those of you that aren't, part of our community to wake the fuck up. I mean, if you don't like swears, then too bad, I swear. Sometimes, just to get you going, right? Just a little bit, So this is a real good opportunity to say, I don't have to wake up having a heart attack about where the US S&P, where FOMO futures are. I'm long Japan and India, right? And by the way, in the USA, we have plenty of equity exposure. It's just not what everybody owns. I mean, we own defense stocks, healthcare stocks, nuclear stocks. There's stocks. We got plenty of stock ideas. You want some stock picks? I mean, J&J, Carnival Cruise, DraftKings. Ooh, this one's tasty. For those of you that aren't married 17 years. Match, Tinder, MTCH. Right there at the low end of the range today, should be. A lot to do.
There's a lot out
without
there.
having to be long Apple and Microsoft. That just broke trend. If you could, you would, right? Like, if you could have got long oil and energy stocks when our breakout signal happened, you've been long them the whole time buying the damn dips. Apple and Microsoft just broke. What do you think that is a leading indicator of? The next AI bubble? I mean, I don't know what you think. I know what I'm going to do. It looks like I got to go.
It is. And on that, we will wrap up. Thank you guys for joining us today. We'll be back in the studio tomorrow at 9 a.m. Stay safe and good luck out there.